It was another tough day on Wall Street with the S&P 500 closing lower by more than 1%, and things could have, quite frankly, been a lot worse. We did find that Apple, the largest component of the S&P 500, actually had a very nice up day, but they were one of just a handful of companies that closed in the green here today. In fact, only about 7% of stocks in the S&P 500 managed to pull that off. So it was an overwhelmingly bearish tilt towards today's session. Of course, tomorrow is a key date. We have the FOMC interest rate decision, and then we've got the press conference with Jerome Powell immediately thereafter. In tonight's video, I will talk about some of the oversold conditions we've been seeing here recently and what to look out for in terms of any sort of whipsaw types of action after that announcement tomorrow. And then we're going to get into the trade application example where I wanted to focus on selling a put on one of the rare dividend aristocrats in the real estate sector. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 20th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. Also, remember at the bottom of those emails, we'll let you know which stocks are giving you overbought and oversold cluster signals within the S&P 500. I imagine there will be quite a few oversold cluster signals in tonight's email. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee, and we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the heat map for the S&P 500 pulled up here. And it was yet another big sell-off day here. Of course, tomorrow, a key event with the FOMC meeting kind of culminating in an interest rate decision. And then we'll have the traditional kind of press conference with Jerome Powell. And so expect some volatility tomorrow, but on the eve of that volatility, it looks like markets were kind of leaning a little bit more bearishly. And of course, after last week, that shouldn't come as a big surprise. Of course, it was 1 week ago from today that the markets were down 4% in a single session. So another pretty tough session here. As you can see, very few patches of green out there. The good news is one of the patches of green is the most important patch of green, which is Apple. Apple was up 1.57% today. And therefore, the end result of the S&P 500 being down just a little bit over 1% could have been quite a bit worse had Apple had a poor day. But I think Apple's positive result somewhat masked an even more aggressive underlying bearishness within the market here today. You'll notice that we also had some green showing up here in the defense contractors, Raytheon, Lockheed Martin, Boeing, and Northrop Grumman. We had a couple of healthcare stocks, Vertex and Moderna, doing pretty well there today. Vertex has a little bit of a play on CRISPR technology. They have a partnership with CRISPR Therapeutics. Of course, most of you are familiar with Moderna as being the company behind the COVID vaccine. Actually just took a COVID test myself today, feeling very under the weather right now, and so fortunately, it came back negative, but whatever I've got, I'm ready to get some rest here. But obviously, Moderna has made its way into the psyche of the investor community here over the last couple of years as a result of their role with the coronavirus and the vaccines. You had a couple of green patches here in the consumer discretionary space, including the casinos. Remember, it wasn't so long ago, maybe a week or two ago, that I did that trade on DraftKings. DraftKings is not big enough to be in the S&P 500, so you won't see it here, but you do see some of the other casino companies. Wynn Resorts was up about 3%. Las Vegas Sands was up over 1%. MGM was up nearly 1%, so a little bit of bullishness there within some of those casinos. And then a couple of the auto parts companies, O'Reilly and AutoZone, doing a little bit better up there. I do see that Aflac managed to close in the green here today. We actually just sold a put on Aflac in my class yesterday afternoon for options for long-term investors. So we were happy to see that that one managed to avoid some of the destruction of the market here today. And then it looks like we have a little patch of green there with the oil refining companies, Marathon Petroleum and Valero and Phillips 66. So those are the oil companies that basically take oil and convert it into gasoline and jet fuel and other distillates. So it looks like maybe the crack spread was helping them out here today. That's about it. There's not a whole lot more I can report out there. There's one or two green slots here or there, but nothing in the way of consistent patterns. And so a challenging day to say the least, with all this red all over the place. I don't even know where to start in terms of pointing out one area that seems a lot more bearish than others. Quite frankly, they all look quite bearish. I would say that real estate probably had quite the suffering here today. Notice that real estate was, I think, completely in the red here today. Every single one of those real estate securities in the S&P 500 closing down today. And we'll actually talk about that a little bit later in tonight's trade application example as well. It does look like all utilities also were closing in the red here today. And most of the financials, which that's saying something, again, Aflac being a little bit of an exception there, but most of the major financial companies like JP Morgan, Bank of America, Berkshire Hathaway, all struggling here today. So it was rough go. I mean, there's just not a whole lot to get excited about here on this very difficult day once again for the stock market. Let's put some numbers behind the breadth measures by coming on over here to the main part of the platform. And as you can see, I've got the S&P 500 pulled up under the visualize test, or the visualize tab, I should say, up at the top. And as you can see, there's only 34 stocks that managed to close in the green today out of the S&P 500. So that was good for only about 7%. So again, today's market activity didn't seem all that terrible, right? If we come over here, look at the S&P 500, it was only down 1.13%. But then we realized that 93% of stocks within the market were lower today. It could have been a lot worse than what we recognize there. And again, I think that's partially because Apple was kind of masking some of that weakness with their own robust up day. And since they're the most influential company in the S&P 500, it kind of balanced things out a little bit more than what you would have assumed, given that 93% of the stocks closed lower here today. Let's also take a look here at chart 6D. Remember, I like to bring this chart up whenever the market is up or down more than 1% in the session. And today was another one of those 1% down days. It's kind of funny because during this stretch of time right here in July, you guys heard me grumbling a little bit about how there was a lack of 1% sell-off days, and I was kind of chomping at the bit to do some put selling techniques. And then it seems like the market gods must have been listening to me, because we've had quite a few of those 1% sell-off days here more recently, and I have been able to implement that, as you well know, here in more of the last couple of weeks when it comes to put selling. So we'll have another one of those put sales here today when we get to that part of the presentation here near the end of tonight's video. But it was a day where volatility was up. So the VIX went up to 27 today, therefore premiums got a little juicier if you're willing to sell puts on companies that you want to own at lower prices. And the other thing I would mention about that is the VIX is certainly higher because of today's sell-off, but it is still not at a level that I would identify as, particularly egregious, right? A lot of times when you have major sell-off days and regular 1% down days, like we saw today, like we saw here on the 15th, and then we had this 4% down day here on the 13th. Those are some pretty aggressive sell-off days there, and you would almost assume that the VIX would be trading higher than it is. You would think that the VIX would at least be into the 30s. Remember, we haven't really been able to crack above 40 this year, which has been a little bit surprising. We got close to it a couple times back in the winter, but we really didn't get above 40. And so beware that obviously tomorrow with a big announcement coming from the Fed, depending upon how the markets react to it, who knows, maybe we get a spiking VIX tomorrow. Remember that the market has a tendency to try to catch you off guard as well. And if we do have a big spillover in the market tomorrow after the interest rate announcement, be on the lookout for potential long lower shadows, because sometimes they try to shake the tree as hard as they can, get all the loose hands out, and then rally the market back the opposite direction. So that's one thing I'm going to be on the lookout for tomorrow, perhaps a negative immediate reaction to the Fed announcement, and then perhaps getting lucky and seeing some of the bulls step in and whip it the opposite direction. Remember, things are a little bit different this time around. I think when Jerome Powell had his 8-minute Jackson Hole speech there a few weeks back that really jolted the markets, there was some hope and some optimism from the markets that we would start hearing a little bit more dovishness out of Jerome Powell. And he came out guns a-blazing during that particular speech and let people know right out of the gate that's not happening. He's going to do his best to stamp out inflation, and he said expect pain. So I think the markets got a little bit caught flat-footed during that moment, and their expectations were wrong as to what to expect out of Powell. I think what the markets do have going for them in regards to tomorrow's decision and his press release is that I think the markets right now do believe Jerome Powell is going to be very vigilant around the topic of inflation and be aggressive in fighting it. And therefore, even if he comes out and says that exact thing, that's where the expectations already are, whereas that didn't seem to be the case a few weeks ago. I think everybody's kind of now realizing, hey, this is a really serious deal, and you should assume that tomorrow Jerome Powell will once again talk tough, whether it's a 75 basis point hike or perhaps even as much as 100. He is likely going to say that we are still going to aggressively try to stamp out inflation. But again, I think the good news is the market is kind of going into that conversation tomorrow with slightly more proper expectations than where it got a little bit flat-footed there back in that Jackson Hole speech. So we'll see. Obviously, the markets are going to do whatever they need to do, and we have to be prepared for any outcome. But that is one thing I'm going to be on the lookout for, is an immediate negative reaction, and then the possibility of the bulls rallying the market after they've shaken the tree a bit. So keep your eye on that possibility. Let's go ahead and get on over here now to the main charts that we like to look at here. This is our 4 grid. And in the upper left, we've got the S&P 500. In the upper right, we've got the Dow Jones Industrial Average. Lower left, we've got NASDAQ Composite. And then lower right, we've got Russell 2000. As you can see, we do remain with strongly bearish postures across the board going into tomorrow's announcement. We know that immediately because the background colors of the charts over today's candle are all dark pink, telling us that not only do we have bearish postures, but it's a strongly bearish intermediate posture for all 4 of these key U.S. equity indices. You can also see that all of the charts did close lower today. The NASDAQ kind of stood out a little bit to me in that it was only down 0.95%, whereas the other indices were down worse, and its candle looks a little bit different there as well. That's more of a kind of a doji type of a candlestick pattern there, which could open up the possibility of a reversal. A lot of times a doji is just a point of reflection of a possible pivot. So you kind of have to say that it's a situation where the market's trying to feel it out. It didn't want to close at the lows. It didn't want to close at the highs. It basically closed where it opened, and therefore there's some indecision in the marketplace right now. And again, I think that probably bodes well for the bulls. Not because we've got a bullish trend. Clearly the trend is bearish, and I think that will likely be the case in coming months. But as we always say, markets don't go straight up or straight down. And so there are momentary situations where you could believe that the markets are destined for lower levels, but because things are so bad in the immediate short term, there could be some sort of a reversion to the mean type of a rally. One of the folks on CNBC today, I think it was Downtown Josh Brown, maybe it was yesterday, he was saying he's looking for a rip your face off rally. And while that doesn't sound very fun, I think we could probably go for that about right now, meaning that the markets could get pretty aggressive to the upside under the right types of situations if things aren't as bad as feared. And so the other thing I think that the markets have kind of going in its favor in terms of some immediate short-term bullishness is that we did get another cluster last week. Notice on the S&P 500 here on the 16th, so September 16th, we got a follow-up cluster to this one over here. Now remember, the previous cluster was followed by 4 straight up sessions, and those were some really nice days there as well, right? Those aren't just your afterthought types of days. We had some nice 1% winning days there and closing near the highs of the session before, of course, the rug got pulled out from everybody last Tuesday. But who knows? Maybe we get a chance to get another reversion to the mean rally back up towards that moving average here before kind of trying to determine where this market wants to go beyond that. So, that's another thing I think the market has kind of in its favor right now, is that things are so bad right now and sentiment is so terrible that the market makers might be incentivized to shake out the weak hands, get people to get stopped out, and kind of loosen their portfolios to get more bearish. And then, of course, once the stocks are stopped out, the market makers end up with those stocks, and they have an incentive to rally that market back the opposite direction. So let's be on the lookout for that possibility tomorrow. The other thing I would mention regarding candlesticks, I talked about the doji on the Nasdaq Composite. You had a pretty nice hammer-esque candlestick here on the Dow Jones Industrial Average, and to a degree on the S&P 500. Not nearly as defined, but that's something that I think is on the plus side of the column there as well for the Dow Jones Industrial Average. But do keep in mind, hammers can't be confirmed until the next day. So we can only say that we are in the midst of what looks like could be a hammer here today, but we won't know for certain that it was until it is confirmed tomorrow. And what we'd want to see there is the Dow Jones ideally closing above today's high. Today's high was 30,888. So if we can get above that tomorrow, whether it's because of Jerome Powell or any other reason, that will bode well that this was an important day where you kind of flushed out some of those weak hands already and then rallied the market back towards the highs, not quite at the highs, but towards the highs by the time it was all said and done. So, a few little green shoots here and there. Obviously, things have been very, very difficult for stock market participants recently, so maybe we're grasping at straws here looking for anything positive. But I think there's a few elements there that at least set up the possibility and has some fertile breeding grounds of the possibility of a rally tomorrow, even if the news is originally declared a little bit more hawkish, because we're kind of due for a little bit of a quick little pop back the opposite direction once again. Now you'll notice that all 4 of these charts do have red moving averages right now as well. And what that signifies is prices below falling moving averages in all of these cases. And remember, that's a bearish feature there as well. So if we do get a snapback towards those falling moving averages, similar to how we reacted right here, you got to be on that possibility of lightening up your bullish trades or perhaps putting on new bearish ones if you think it's going to roll over underneath that rising 30-day moving average like it did last time around. So keep your eyes on that possibility. I doubt that would happen in one day, but then again, we've seen crazy things happen in the market. It's certainly possible, but I would say it's probably highly unlikely that we would get all the way back to the moving average in one single day. It would be a pretty epic day if that happened. We had one of those back when, remember when Trump was elected president. The market was gapping down that morning in the futures market, and by the end of the day, the markets had just ripped the opposite direction. So sometimes goofy things do happen in the market where the majority of participants are caught flat-footed, and it just kind of feeds upon itself, almost like a domino style of action. And so I guess it's possible, but I wouldn't put that in the likely side of the equation. It would likely take a few days to get back to that moving average if we are destined for those areas. But let's keep our eye on the activity tomorrow. It should be a pretty wild session. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support this presentation. Remember, David and I provide this to you for free of charge, and so it's nice that you guys are willing to support this. Obviously, on a day like today where I'm feeling very under the weather, it certainly crossed my mind not to do the video at all, because obviously it's not required to do if I'm just putting it on YouTube for free. But I do try to be held accountable to those days whenever I'm around, and so I'm kind of gutting through it right now. And if you appreciate the effort, then all I request is that you click like for me there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do the video next, which should be Thursday, I will plan on doing another full-length video, including 12 grids and doing the trade application examples and all that kind of good stuff. If we're under 100 likes, then we'll just keep it nice and short and only do a review of the indices. Thank you to all 112 of you that did that for me last time around. Let's go ahead and also talk about our sector selector. Oh, and by the way, earlier today I taught my dividend growth investing class where we concentrated on the consumer staples space. That recording has now been posted up here to our trading rooms tab for those of you who are premium members that want to review that recording. Remember, when markets get very bearish, like we've seen here more recently, more interesting opportunities start to emerge for long-term investors as well. So hopefully in the next year or two, we'll start seeing some really nice long-term opportunities despite the bearishness that we all have to put up with along the way in order to receive those excellent long-term opportunities. So I think this is going to be a good couple of year stretch to be starting to set your sights a little bit more so on long-term dividend growth investing. And if you'd like my assistance with that, I do teach that class every single Tuesday morning. Earlier today, David did teach his directional option strategies class as well. So make sure you're checking that out if that is of interest to you. So he is back in action after his long road trip over the weekend, and I'm assuming he'll be back with you tomorrow here on this video as well. Let's talk about the sector selector tool. And the sector selector is something that I put together on the weekend in preparation for my Monday top-down trend trading class. I then put together the factor selector tool on Tuesday nights in preparation for my factor-based swing trading class on Wednesday morning. So I'll see many of you in that swing trading class first thing in the morning tomorrow. But we already had the conversation in my top-down trend trading class about this sector selector tool on Monday. So feel free to check out that recording if you're a premium member. But as you can see, we did see that utilities remain number one up there at the top echelon, and that's probably just a reflection of a risk-off type of a market sentiment that we're in right now, where the utilities are a bit more defensive in nature. You do see that energy continues to command some attention up there near the tops as well, and that's probably because oil prices have remained reasonably resilient in this higher inflationary environment. You did see that consumer staples slipped down to number 4, but again, they kind of benefit from the same thing that utilities do, which is a more defensive mindset type situation in the market itself. But I'd say that the key surprise this week was consumer discretionary. Notice that consumer discretionary went from number 6 the week before up to number 3 here this most recent week. So we talked about that and spent some time reviewing a number of consumer discretionary stocks in our class yesterday and confirmed that there are some pretty decent looking trends in that area, strangely enough. The reason that we're pointing that out a little bit more is that that should not necessarily be the assumption. When markets are more difficult, typically consumer discretionary struggles mightily. But right now there are some areas, and we saw some of them on the 9 at 9 this morning on the plus side of the column. I also talked about some of them when we were just looking at the heat map a moment ago, when I was talking about Wynn Resorts and Las Vegas Sands and MGM and the auto parts retailers like O'Reilly. Those are discretionary stocks. And so some of them are actually hanging in there reasonably well right now, which is a little bit surprising. But you just never know. You can find opportunities in surprising areas every so often, and this kind of seems like it's one of those times. The other thing that I would mention is on the downside. We did have communication services finally get off the mat. They are no longer dead last, but they're still second to last. And they were replaced by materials. Very rough week last week for a number of the iron ore and steel companies, I noticed. And so I'm sure that had a pretty big impact in materials and how they got ranked and scored from this relative strength perspective right here. All right, let's go ahead and get back on over here to the main part of the platform now. And let's do some 12 grid analysis, starting with chart 5A. And a reminder that when you're pulling up these 12 grids, if you're a premium member of ours that has access to all the 50 plus different charts, the background colors of the 12 grids will tell us what is the current posture. So because they're so small and miniature, we can't have the color changing effect. Technically we could have it, but it just would mesh everything up so much that you couldn't make heads or tails of it. So when you look at it from a 12 grid perspective, it's basically telling you that of these 12 different charts that we see in front of us right now, the one in the lower right and the lower left have a green background color, and that means that those two stock charts or asset classes would be considered bullish according to the intermediate line on the market forecast. All the rest of the charts are red or pink, and that means that they are considered bearish here currently. So it seems like that has been a running theme of 2022. For those of you that have been listening to David and I regularly during this presentation, which is probably most of you, every so often we'll have people pop in by just randomly finding us on YouTube, but I would imagine that most of you are probably pretty loyal to listening to us, so this will sound like a little bit of a broken record, but it is what it is. We're here to report what we're witnessing, and what it has been is a common theme that the U.S. Treasury yield, the 10-year U.S. Treasury yield to be precise right here, has just continued to rally. And then the U.S. dollar has also been very strong. So it seems like that has been the case so often that those two are the only two that have been bullish. The U.S. Treasury yield did hit 3.6 at one point today. It closed a little bit off of that at 3.57. Nonetheless, that is an 11-year high, as you guys might have seen me mentioning on Twitter earlier this morning. So that's really saying something. We've seen yields basically go straight up. There was another fascinating quote that I heard on CNBC yesterday where they were saying that only 16% of the stocks in the S&P 500 currently have a dividend yield that is in excess of the, I think it was the 2-year Treasury note yield, and that is quite rare. And then they were also saying that only 20% of the stocks in the S&P 500 had dividend yields more than the 10-year Treasury yield, because remember, we have an inverted yield curve right now, so that's why those numbers are a little bit different than you might assume right out of the gate. Right now, the 2-year is actually a higher yield than the 10-year, but whether you're using the 2-year or the 10-year as your proxy, it's basically saying, less than 1 in 5 stocks in the S&P 500 has a higher dividend yield than what is available as an interest payment directly from the U.S. government. So that remains a challenge of this market right now. For years, there were simply no alternatives. If you wanted income, you had to get it from the stock market. Today, there is a choice. You can certainly make the decision to stay out of the stock market for the next 2 years, collect 4% annualized from the U.S. government, and be made whole after 2 years. And then, you're free to do whatever you want with your money immediately after that. Remember, a few years ago, you wouldn't have even been able to get 0.2%, right? So that's how much difference there is in just a very, very short amount of time. This has been one of the most rapid rises in the interest rate environment that the world has ever witnessed. We're living through it right here, right now. And there's people making that decision, not just institutional investors, but individual investors as well. And so, there are dollars that are being competed over right now between the stock market and the bond market. And the bond market is winning over some of those dollars at a much greater pace than they would have years ago when interest rates were much lower. And therefore, every dollar that does not get directed into the stock market and instead gets directed into the U.S. Treasury market means that there's one less dollar to support the stock price values as well. So it's been quite interesting, to say the least. But, this market likes to keep us on our toes, that's for certain. So a big day there for interest rates, once again, right on the cusp of Jerome Powell's comments tomorrow. And then the U.S. dollar remains quite strong here as well. Remember, for a brief moment in time, I think the last time I was with you on Thursday, we had a white background color because I was telling you how rare that was, where the intermediate line was basically flat day over day. But the intermediate line is back to rising once again, and we're in the upper reversal zone as well. And therefore, we do continue to have a strongly bullish posture once again on the U.S. dollar. And that should not come as a surprise. You look at that chart, clearly starting in the lower left, ending in the upper right. The U.S. dollar is not the most exciting investment on planet Earth, but it's kind of the best house in a bad neighborhood. And when market conditions get chaotic, sometimes people feel just comfortable settling in on the most liquid currency on the planet. And so that's kind of where things are right now. All of the other charts, as you can see here, are quite bearish. They all have strongly bearish intermediate postures. And it looks like, all of the rest of them also are trading below falling 30-day moving averages. So it's pretty bleak out there. And remember, this is a pretty wide-ranging group of investments here. Everything from gold and oil to Bitcoin to high-yield bonds, foreign bonds, long-term U.S. treasuries, preferred stocks, foreign emerging stocks, foreign developed stocks, and U.S. large-cap stocks. All of those other categories have the strongly bearish postures and are trading below falling 30-day moving averages. Trends are clearly bearish in most areas of the market right now. And so there are very few places to hide, unfortunately. Again, if you're lucky enough to be in, the U.S. dollar as a currency play, maybe you can avoid some of that. But for the most part, this has been tough sledding. Whether you're invested in the stock market, cryptocurrencies, commodities, bonds, it has been a massive loss of value across the board. So if you're finding 2022 to be a challenging year, I can assure you, you are not alone. I was mentioning on Twitter the other day that there are probably a lot of people that started the year 2022 thinking that long-term investing is easy. And those very people that thought that in January of 2022 will likely realize by December of 2022 just how hard it is to be a long-term investor when conditions are this grueling. It's easy to be a long-term investor when markets are behaving themselves and gently rising over time. But these are where you kind of earn your stripes, these times that we've been going through here recently. And remember, they will change. I spent some time talking about that in the last video as well, but our job right now is just to survive, because if you don't survive, you're not going to be able to take advantage of the eventual bull market that will emerge. Now, I don't want to make that sound like a bull market is just around the corner, because I would actually be personally surprised if that was the case. Typically, if we're in more bearish market conditions, they can last many months, if not multiple years. So you have to make sure you're comfortable with where things are positioned right now. But I also do believe that within a number of years, we'll be back to all-time highs. And if you're so disgusted with the stock market between now and then, and you give up, then you won't be able to be around to benefit from that. So do whatever you need to in order to make sure you survive these difficult times. But without a doubt, it has been a challenge, and I'm right there with you with that thinking. It's I wish it were a little bit easier, but life's not that way, right? Life makes you work a little bit, and right now the investors are having to get worked over in this calendar year. In terms of the other charts that are so bad that it's getting to be good, remember there are those little green dots that are starting to appear here and there. And those little green dots are what we refer to as oversold cluster signals. And sometimes they can kind of provide the fodder necessary for a reversion to the mean type of a move. So you should know that preferred stocks ended today with an oversold cluster signal. We had foreign bonds that ended today with an oversold cluster signal, and we had Bitcoin end today with an oversold cluster signal. So, those don't work quite as well when you're dealing with wilder types of asset classes like cryptocurrencies, but it at least is something to remind us that eventually the selling gets too extreme, and we're going to need to relieve that selling pressure in one way or another. And it is just going to, be added to that commentary that I mentioned before, that we have the environment where a snapback rally could be in the cards starting rather quickly. Now, obviously, if we take out June's lows on the S&P 500 tomorrow because of some sort of awful reaction to the interest rate environment, then all bets are off, right? Then it is clear we are going to go into a bear market, and you better brace yourself for the worst. But as long as we don't take out those lows from the summer and we have maybe some sort of a mini reaction to the downside only to close near the highs of the session, I think you can kind of build on that for a day or two thereafter as well. So I'm looking forward to seeing how the market reacts tomorrow. It should be very, very interesting. Let's go ahead and now take a look at our 12 grid for the U.S. sectors. And this will be chart 5C. And as you can see, we do have a clean sweep here today for bearishness in all 11 sectors. When I was with you last on Thursday, energy had a green background color, but you can see energy has now sold off 4 days in a row. That's what the red outlines of those candles represent, right? Some of these are black outlines, some of these are red outlines. And so this one was barely a down day, but nonetheless, it did close just a little bit lower here yesterday and then again today. So this is technically the fourth day in a row to the downside for energy. And in doing so, you can see that it breached its upward trending 30-day moving average and has caused enough pressure on price to now change the intermediate posture to weekly bearish because the reading is at 56 and falling. And so remember, if it falls below 50, then the background color will turn to that darker shade of pink like all the rest of the charts. But right now, it's not quite to that level. So we'll see if that happens here as soon as tomorrow or not. But it's pretty bleak out there, as you can see from all the rest of these charts. We've got strongly bearish intermediate postures across the board, and every single one of the charts except for energy has a red moving average, telling us that 10 out of 11 sectors are trading below their falling 30-day moving averages. That is not a good sign. There is a lot of selling pressure that has hit this market in just a couple of weeks' time here. So, we'll see where it takes us. Some of these charts, by the way, are still reasonably close to their moving averages. I would put utilities in that category. They're not all that far removed from the moving average here. But then you've got other charts, and by the way, here's discretionary. So going back to what I had mentioned before, it's a little bit surprising that discretionary is holding up reasonably well. on a relative basis, right? You look at where the candle for discretionary is, it's pretty close to its moving average right now. And then compare that to something like consumer staples. You would think those two would be exactly the opposite. But right now, there's a lot more separation between where consumer staples is trading and its 30-day moving average than what you're seeing on discretionary. So discretionary is kind of like a little bit of a secret outperformer there that I don't think a lot of people are talking about right now. One that is certainly not a secret outperformer is real estate. Take a look at real estate just getting blitzed here in the last week and a half. You had a really nice 5-day rally up to that falling 30-day moving average, and then it has just been torpedoing lower nearly every single day. And where we ended here today on real estate was fresh 3-month lows. And this is something that has been catching my eye this week as I've been looking at different stocks and REITs and things like that to sell puts on. And as I mentioned before, that is where we're going to concentrate our effort in tonight's video on our trade application example is selling a put on a REIT that you may want to own at a lower price depending upon your mindset. Because things have gotten so bad that you would think that there would be some sort of a stabilization. You're not just going to completely collapse day after day forever. So with that notion, and you can see here, by the way, REITs were down 2.63% today. So they were the worst sector here today. So in other words, most real estate investment trusts were probably down 2, 3, 4%, and therefore volatility, implied volatility levels on those REITs were probably way up today. And therefore, if you want to be brave and own those REITs at lower prices, then selling puts to take advantage of that high implied volatility after an aggressive sell-off day like today could be a worthwhile consideration. Obviously not a recommendation or anything like that, since we don't offer those, but something to consider at a very minimum for those of you that feel like you might be a little bit underexposed to real estate in your investment portfolios. Right? I know that's the case for a lot of dividend growth investors. REITs can be a little bit of a challenge to find with long histories of increasing dividends compared to something like the consumer staples, because REITs do have to pay out 90% of their net income as a dividend, and therefore if they have a couple of down years in a row, it's almost a guarantee that they're going to end up cutting their dividend. And so you don't really see the REITs build up their streaks nearly as much as you do in the other sectors. However, there are a couple of exceptions to that. There are 3 dividend aristocrats that are in the real estate sector. One of them is Realty Income, the monthly dividend paying company, ticker symbol O. Another one is Federal Realty, which is actually one of the oldest REITs and certainly the longest streak of increases amongst REITs. Its ticker symbol is FRT. And then the third aristocrat that is a REIT is the one that we are going to use as our example to sell a put on here tonight. So let me go ahead and bring up chart 2A, our dividend stair-step chart. And I'm going to type in ticker symbol ESS. That is Essex Property Trust. And this is the third aristocrat that is a REIT. Remember, there's about 64 aristocrats these days. There used to be 65, but one of them got bought out. And so an aristocrat, just in case you're not familiar with that term, is a company that belongs to the S&P 500 and has raised its dividends for 25 years in a row or more. So a rather select group of companies there that can make that achievement. And of course, a lot has happened over the last 25 years. A lot of very difficult economic circumstances have occurred. And, aristocrats usually have done a good job kind of going through the gauntlet of difficult economies and still coming out the other side raising their dividend. And so while that's not a guarantee for the future, what it does tell us is in the past they have successfully faced those challenges and continually raised the income stream for their shareholders. So this is Essex Property Trust. And remember, if you do have access to our premium charts, one of the new features of this dividend stair-step chart is all the stocks that are aristocrats are going to have this little purple label up here at the top telling you that as well. some of you will have memorized those 64 names that are part of the aristocrats, but some of you might still need to jog your memory there. And so the hope is that that label will help you along with that. But here's the reason I'm looking at Essex Property Trust. Truth be told, I was close to bringing this to my class's attention today in the dividend growth investing class, but we have a little bit of a conundrum right now, and that conundrum is that the 10-year Treasury yield is so darn red hot that even a REIT like Essex Property Trust does not have a yield in excess of the 10-year Treasury. You'll see that this maroon label in the upper right is telling us that the 10-year Treasury yield is 3.57%. Whereas the dividend yield of Essex Property Trust in the black label over here is only 3.5%. So this is a company that's nearly in line with the 10-year Treasury, but just a hair shy of it. So some of you might be comfortable with that idea of just buying it outright if you've needed some REIT exposure. There are certainly worse REITs out there. So you can see that this particular REIT has a little green dot showing up underneath this week's candle. Remember, this chart is a 10-year weekly chart. So each one of these bars here represents 1 week in time. And so on a weekly bar chart, we have an oversold cluster signal if you're using the market forecast technical indicator. You will notice that Essex also had an oversold cluster signal right here that I'm kind of circling with my mouse, and that was back on the week of June 13th, and it basically represented the bottom. Now, I don't know if this one that we just got here today will represent the bottom and this thing will start rallying from here, but at least that's a pretty decent hit rate. You'll also notice that we got a couple of oversold cluster signals on a weekly candle chart back here in January of 2018. And of course, that stock ended up having a pretty nice run out of those oversold cluster signals to the upside immediately after that. And then we had another green dot show up way back here. I know it's probably pretty hard to see, but this is back in November of 2012, so nearly a decade ago. But that was when this particular REIT was trading at $136, and that would have been a brilliant time to be buying this REIT, as it eventually went on to $363 by the time it was all said and done. So I would say this one has a pretty good hit rate in terms of how does it react to oversold weekly clusters. It seems to me that it attempts to find a bottom around those levels. And of course, to sweeten the pot here in this case, you can see that we went from being above the blue zone last week to now being in the blue zone this week because of that big drop off in real estate investment trust prices. For those of you that are not familiar with this chart, what it's effectively doing is it's making a calculation to determine where the average high yield is and where the average low yield is for any given company over the last 10 years. And so the simplistic approach of looking at it is just simply when the stock is trading in the blue zone, it means that its current yield is attractive compared to this specific stock's yield history over the last 10 years. And so, we've had a couple of opportunities here this year where that has happened. But again, one of the challenges right now is the yield is a little bit less than the 10-year Treasury. So one way to kind of overcome that, if you decide that's important to you, is rather than buying it right here, right now at $251, instead consider selling a put on it. Now, one thing I will warn you of is this is not the most liquid options candidate on planet Earth. And remember, that's often the case. When we are trying to do something very specific, like build a long-term portfolio based upon dividend growth stocks, we're not looking at Netflix and Facebook. They don't even pay dividends. And so this is a little bit of a challenge for some folks that require liquidity. But if you're truly committed to the idea of owning a company at a certain level, known as the strike price, then you can put in a limit order, and as long as you get filled, great, because you're planning on holding, in some cases, through thick and thin. And therefore, you don't need the liquidity to get out. Now, if you do want to roll, that can become a problem. So it really depends upon your personal circumstances, and all of you have different circumstances. To each their own. Like right now, we are rolling the Scott's Miracle Grow sold put trade that I had done a month or so ago. but some of the other trades we might not be, right? It just depends upon circumstances. So if liquidity is important to you, this is probably going to be one that you would pass on. On the other hand, if you feel like you have an under allocation towards real estate investment trusts in your long-term dividend growth investing portfolio, then this would be a way to perhaps be able to lock down a nice juicy yield at a reduced price. So what I did is I went out to the October $230 strike, and that would put our break even somewhere right around here. Now I think I got $2.70 for it, and so if we get our calculator out and I take 230, the strike, in October. And the reason, by the way, I did October instead of November is because they have an earnings announcement coming up here at the end of October. So I'm hoping to get out of it before their earnings announcement if the stock does not close below 230. But if it does crater, right, again tomorrow, maybe the market just gets absolutely annihilated, that provides a little bit more optionality for me in case I do want to roll it then to the Novembers. So anyway, this is one where I stuck with the Octobers because of when this company reports its earnings. And so we did the 230s and we got $2.70 in terms of our credit for selling those 230s, which means that our break even and our eventual cost basis, if we decided to accept an assignment or an exercise, would be $227.30. Now to figure out what that yield would be, because again, right now when it's a $251 stock, it's a dividend yield of 3.5%. But at $227, that dividend yield will be higher than 3.5%. So in order to calculate that, we would take the current dividend amount on a quarterly basis over here, which is $2.20, and take that times 4 to annualize it, meaning that this company is likely to pay out $8.80 in dividends at its current rate on an annualized basis. Then divide that number by the 227.3 that we calculated just a moment ago, and our yield would go up to 3.87%, which is pretty tremendously above the 3.5% right now, and obviously would be well above the 10-year Treasury yield right now as well. But of course, the 10-year Treasury yield is not a static, hurdle either. For all I know, it could go up to 3.87 by the time the October expiration week appears. So there is a little bit of an element of an unknown that you just kind of have to take a leap of faith there to a degree as well. The other thing that I would mention here real quick on this particular stock is it is a little bit of a higher price stock. Remember, when you're selling puts, you're effectively committing yourself to buying 100 shares of stock. Since all of you have different account values, for some of you, spending $25,000 by buying 100 shares of a $250 stock may not be something that is feasible for you, right? So determine for yourself whether this is a good candidate or not, given your typical position sizing and things like that. But I thought it represented kind of an interesting opportunity for a dividend aristocrat that is somewhat of a rare REIT. Only 3 out of 64 are REITs, and this REIT specifically has rarely traded in the blue zone over the last decade, and even more rare than that is being in the blue zone at the same time as getting an oversold weekly cluster signal, just like what happened here back in June, where we had a nice and favorable response to that oversold level. So that's what I had for you here tonight. I hope you got some value out of tuning in. If you did, I simply ask that you give up 5 seconds of your day to click like for me there on Twitter. It's your best way to thank us. It's our way to try to get the word out about our organization, knowing that you guys all have your own unique social circles, and when you do things like retweets and likes and all that kind of stuff, then it gives David and I a greater opportunity to get out to folks that you might know and friends and family that you might very well recommend us to. And we really appreciate those of you that are willing to do that. So thanks again for tuning in. Tomorrow's a big day. Let's keep our eyes peeled to the activity. Let's watch out for whipsaws and head fakes. There's a lot that can happen tomorrow after not just the interest rate announcement, but then an hour or so later when Jerome Powell actually starts his press conference. So expect volatility tomorrow. And then as far as I know, David should be back with you in this video tomorrow night, and then I will plan on being with you on Thursday. So until then, I want to wish you all the best of success with your trades and your investments. Goodbye for now.